So current liabilities and payroll. Learning objectives account for current liabilities of a known amount. Calculate and journalize basic payroll transactions. Account for current liabilities that must be estimated. Account for contingent liabilities. And use the times interest earned ratio to evaluate business performance. Accounting for current liabilities of a known amount. So we've talked about liabilities are debts that we owe to creditors. They have three main characteristics. So they occur as a result of a past transaction or event. They create a present obligation for future payments of cash or services. And they are an unavoidable obligation. It's an obligation that we are obligated, we are supposed to pay. And then liabilities are broken down into either a current liability or a long-term liability. Current liabilities are due within 1 year. They must be paid either with cash or goods and services. A long-term liability does not need to be paid within 1 year of the entity's operating cycle. So that's anything over 12 months would be considered long-term. And some examples or some accounts that you would see that are current liabilities would be accounts payable, sales tax payable, and unearned revenue. And then for long-term liabilities, we have notes payable, mortgage payable, and bonds payable. And there are more accounts than this that fall within these categories. These are just the typical ones that you would see. So this problem starts on page 557 in your book, sales tax payable. So most states assess sales tax on retail sales. Retailers collect the sales tax in addition to the price of the item sold. Sales tax payable is a current liability because the retailer must pay the state in less than a year. Sales tax is usually calculated as a percentage of the amount of the sale. So, for example, suppose December's taxable sales for Smart Touch Learning totaled $10,000. The company collected an additional 6% of sales tax, which would equal $600. So to find that, we took the 10,000 times 6%, and to convert that into a decimal, 6% is 0.06. So 10,000 times 0.06 gave us the 600, which is the sales tax. The accounting clerk would record that month's cash sales as follows. So we're looking at the journal entry. And first we're going to start with the date. So we have December 31st. And we had a cash transaction. So we're going to debit cash for $10,600. We're going to credit sales revenue for the $10,000, which was the price of the, let's see, was it services? And then we're going to also credit our sales tax payable. And sales tax payable is that $600. So one common thing that I see here is sometimes students will see the 10,000 and they will assume, or not really assume, but I guess jump to the answer and put 10,000, and then they'll subtract the 600 out of the 10,000. The 10,000 is actually the revenue. So just make sure that you remember that the 10,000 is the revenue. So anything over that is your sales tax. So your total for cash would be the 10,000 plus that 6%, which is 600. So cash was 10,600. And they also show you how this affects our accounting equation. If you look to the right in the book on page 557, it's showing us that our asset cash is going up because we received $10,600. And our sales tax payable, which is a liability, we owe this $600 now in taxes, that's going up. And our sales revenue, which is part of our equity, that is also going up. So if you plug those numbers in, you would put $10,600 under our assets for cash. You would put $10,000 in our sales revenue and $600 in our sales tax payable, and that would balance out both sides of our accounting equation. Sales tax is not an expense of the business. It is a current liability, and companies collect the tax and then they forward it to the state at regular intervals. So some companies do this quarterly, so every 3 months they will send tax payments in. And then other companies do this monthly. It depends on the company, and it also depends on the size as well. And it's really just, it depends on a lot of different factors. So here we see on January 20th, we debited our sales tax payable account and we credited cash to record the cash payment for our sales tax payable. So we're going to assume that Smart Touch Learning incurred federal income tax payable of $3,780. So here we're debiting our income tax expense by $3,780, and we're going to credit income tax payable by the same amount, and this is to record our income tax expense incurred. Unearned revenues. So now we've received $900 in advance. So someone paid us early. So they paid us on May 21st, $900 for a month's work that's going to begin on that date. So we are going to debit cash the day that we receive this cash for $900, but we have not yet performed the work, so we haven't earned the revenue. So we're going to put that $900 in our unearned revenue account. So to do that, we're going to credit unearned revenue, and our note is that we collected cash for future services. And then during May, Smart Touch Learning delivered 1/3 of the work. This shows up perfectly on the PowerPoint. Yeah, because I can see it on over here. Okay, so during May, Smart Touch Learning delivered 1/3 of the work and earned $300. So I'm just going to write this real quick so that you know what this looks like. So they earned $300, and then they have in parentheses the $900 times 1/3. Okay, so that's what we can't see. So we delivered 1/3 of the work and we earned $300. To get that $300, they took the $900 times 1/3, or 900 divided by 3, of the revenue. So on May 31st, the accounting clerk would record the following entry. We're going to debit unearned revenue by the $300, and we're going to credit service revenue to show that we earned $300 of that revenue. And the note is to record service revenue earned that was collected in advance. So we're not taking it from cash because we already brought the cash in. We're going to, once we earn this amount, this $300, we've already been paid for it, so we're pulling it out of unearned revenue. And then we are So that actually might help you with your assessment question. Maybe. I don't know. Keep thinking about that. So assuming on May 1st that we purchased merchandise inventory with a 10% 90-day note payable for $8,000. So we have a note payable, it's 90 days for $8,000, and it's got a 10% rate on it. The company uses the perpetual inventory system. We are going to record this journal as debiting our merchandise inventory for $8,000, which is the price of the note, and we're going to credit our notes payable the $8,000, which is the price of the note. And then in our note down here, we're going to put purchased merchandise inventory in exchange for 90-day 10% note. So this is a good slide for you to refer back to as well. I know most of this we've already kind of seen a few times, different journal entries. They're pretty similar to, most of them are pretty similar to the ones that we've already seen. This one is showing you interest, and there's also how to calculate interest in here. So it's a good one to refer back to when you're working on your homework and stuff. But slide 14. So on July 30th, when the note is due, we're going to have to pay back the note and the interest. So we're going to debit our note payable for the amount of the note, which was $8,000, because that's all we owe on the note. However, they were charging interest. So we also have to pay the interest on the note as well. So to calculate the interest expense, we're going to take the $8,000 note times 10, because it was a 10% note, so times 0.010. And then it was a 90-day note, so we're then going to multiply that by 90 days out of a year. And for a year, they use 360 days. So just make sure that you note that, refer back to this. A year is 360 days. To calculate the interest expense, you're going to take the amount of the note. Let's see if I can type this in here. No, I don't want to. Let's see. There it is. Oh. No. I thought that was it. Sometimes it gives me a text box. I do not want to draw it. You guys know that my drawing is terrible, especially with a mouse. I'll just write it on the board. Okay, so you're going to take the amount of the note, and you're going to multiply that by the percentage of interest, and then you're going to multiply that by the number of days until it's due. Let me just use the wording that they have here. 10% 90-day note payable. So the number of days of the note payable divided by the number of days in a year, which is for them 360. Okay. I feel like these X's are kind of getting, they're just kind of blending in with everything. So amount of note times percentage of interest times the number of days of the note payable divided by 360. So we've debited our notes payable by $8,000. We calculated our interest to be $200. So our total debits are $8,200. That's what we have to pay when we're paying this note. So we're going to credit our cash account by $8,200, and that is to show that we paid the note and the interest at maturity. So long-term notes payable are typically reported in the long-term liability section of the balance sheet. When the long-term debt is paid in installments, the business reports the current portion of notes payable as a current liability. Good morning. The remainder is classified as long-term. Does anyone have any questions currently on Objective 11.1? Not at this time? Okay. All right, so now we're going to calculate and journalize basic payroll transactions. So how do companies account for and record payroll? Payroll, also called employee compensation, creates liabilities for a business. For service organizations, payroll is the major expense. There are numerous ways to label an employee's pay. You could get paid salary, commission, compensation, bonus, and benefits. Gross pay and net pay, which is also your take-home pay. Okay, I get this question a lot, or I used to. I don't get it as often anymore. But a lot of times people would ask, what is the difference? Some companies, especially when you're going to buy something, some places ask you, well, can you give us your gross pay? Or can you give us your net pay? And you really want to make sure that you're getting those numbers right, because they can be very different. Your gross pay is the total amount of your salary, wages, commissions, and bonuses that are earned during the pay period. It's absolutely everything that you have earned during that pay period. Your net pay is the amount that the employee gets to keep. So these numbers can be very different. You have taxes, Social Security, you might have insurance through your employer where you have that deducted from your paycheck. All of these different things can affect your net pay. So your gross pay could be $500, but your net pay could be $300. And so you really have to make sure that you know what these are, because especially when you're trying to buy something, if you told them, if they asked for gross pay, which would be the $500, but you told them $300, they might say, oh, I don't know, you're probably not gonna be able to keep up with this. If they asked you for your net pay of $300, but you gave them your gross pay of $500, now you're overstating what your pay is. They might give you whatever it is you're looking for. They might allow you that loan, but then it might be very hard for you to keep it because you don't have the money coming in to cover the payments for it. So it's very important that you know the difference between gross and net. Gross is the bigger number. I'm trying to think of how did I remember it? It used to confuse me a long time ago when I was like in my 20s. Gross is it's everything. Net, maybe think of like what falls into the net or what you're catching. I don't know how to explain it really to help you differentiate between the two, except that gross is everything. G comes before N. Gross pay is everything before you subtract all the other deductions and taxes and everything. So gross comes first in the alphabet, and it also comes first when looking at your money, and then net is what's left. So employee payroll withholding deductions. There are many different types of deductions. Some of these deductions, goodness. Some of these deductions are required and some of them are optional. So the ones that are required, your federal and state income tax, Social Security tax, and then other deductions that are required by law, by federal, state, or local law. Optional deductions are insurance premiums, retirement plan contributions, charitable contributions. So when you get paid, if you look at your pay stub or your pay printout, you will probably see on there, you've got your gross pay, which is the higher amount, and then you're probably going to see, you'll see like federal income tax withheld, state income tax withheld, Social Security, other deductions required by law. So you'll see like federal or state or other local taxes potentially. And then if you have insurance through your employer, then you'll see somewhere medical or insurance premiums. If you are contributing to a retirement plan, you will see that, charitable contributions as well. And those can reduce your overall taxable income at the end of the year, which can reduce your tax burden. So if you typically owe taxes, but you're contributing to a 401k, or especially with medical, that could help to reduce. If you have the option of an HSA and you do go to the doctor sometimes, that can also reduce your tax liability at the end of the year. Or if you normally pay, then maybe you won't have to pay so much. Or if you get a refund, maybe you'll get a better refund than the prior year. But there's a lot of other factors that factor into that too. So, like your gross pay, and tax law changes all the time. So the income tax deducted from gross pay is called income tax withholding. So when we take our income tax from our gross pay, we call that income tax withholding. And the amount withheld depends on the employee's gross pay and the number of withholding allowances claimed. So if you're unmarried, you usually just claim one, just yourself. Someone that does not have any children, but they are married, normally they claim two, one for the main filer and one for the spouse. And so here we have an example of withholding for employee income tax. This is a Form W-4. This is your employee withholding allowance certificate. So we see here we've got the person's name, their social, their address, and then this person, they are claiming a total number of allowances of 3. So what do we think based on looking at this about this person? So they're claiming 3 allowances. They're stating that they're married. So what do we initially think about this particular employee? In the prior slide, it states that unmarried taxpayers, one person, single, usually claims 1 allowance, and a married couple with no children usually claims 2 allowances, one for the person and one for their spouse, 2 people. So when we look at this withholding certificate, he said that he was married, so we know he's probably going to claim himself 1 and his spouse, so that's 2. But then down here in allowances, he's claiming 3. So what do we gather from that? They probably have a child. Yeah. So the employee, Ryan, he's married, so he's claiming his spouse, but he's also got this 3rd allowance that he's claiming. So more than likely, they probably have a child. So the Federal Insurance Contributions Act, also known as FICA, and you probably see this if you've looked at your payroll receipt. FICA is also known as the Social Security Act. and created the Social Security tax. The law requires employers to withhold Social Security tax from employees' paychecks. FICA has two components. We have OASDI and Medicare. And OASDI stands for OASDI stands for Old Age Survivors and Disability Insurance. Medicare is medical benefits. Payroll register. So many companies use a payroll register to help summarize the earnings, withholdings, and net pay for each employee. And so here we're looking at our payroll register. We have, this is also on page 564. So on our payroll register, we have a list of our employees. We have their earnings. So in the beginning of the payroll register, we have earnings. We've got our beginning cumulative earnings plus whatever they've earned in that current period, and then the ending cumulative earnings. So this is just somewhere for us to quickly look and see what this employee has made during the year. So our first employee, James, he made $112,000, but then in our current period that we're running payroll for, he made $10,000 during that payroll period. So we're going to put $10,000 there. And then when we add those two together, after he has paid that, his cumulative earnings would then be $122,000. And then next, we are also tracking our withholdings. So, and this is very good for any of you entrepreneurs that might want to hire people one day. This is something that you definitely want to get right, payroll. So, for withholdings, we see that OASDI, which is old age, let's get back to it, old age, survivors, disability insurance. So we've taken $267 out for that, for him. And then we've also pulled $145 for Medicare, $2,000 for income tax, $180 for health insurance, and then $20 for something else, which then we calculate the total withholdings. This is everything that we're withholding from his gross pay, $2,612. So now to figure out his net pay, and this is a good way for you to, there's some formulas in here if you're noticing, by the way. So this is a good slide to refer back to. Here. So if you're asked a question, the beginning cumulative earnings was this, their current earnings was that, what are their ending current cumulative earnings? Well, you know you're going to take beginning plus current equals cumulative. If they tell you the beginning is this and the cumulative is that, then you know you're going to take cumulative minus beginning to get current. And you can refer back to this slide. This is slide 23. If they say, these are all the different withholdings, please calculate their withholdings. You're going to take all of the withholdings and add those together. And that's going to equal your total withholdings. If they tell you that your current period earnings is $10,000, and your total withholdings is $2,612, you're going to take the current period earnings minus your withholdings to equal your net pay of $7,388. So current period earnings minus total withholdings equals net pay. So there's a lot of different formulas on here. There's different ways that questions can be asked. So when you're looking at your homework or your quizzes or your exam, just remember to come back to this slide and look at it, because it should be able to help you. And one thing I would do, I would recalculate one of these, pick one of these people, recalculate what they have. If you get the answer that we have listed out right here in this little screenshot, then you know you calculated it correctly. So then you'll just plug in the numbers from your question and you'll be able to calculate it, and you should get it right. So then after we have our net pay, we are then going to see the check number that we paid them with on our register. And then we have this other column for our salaries and wages expense. So this is what's going in our salaries and wages expense for the company. So even though the employee is only getting $7,388, our salaries and wages expense is still going to show $10,000, because 2,612 of that is going into all of these withholding accounts. So these are still part of your salaries and wages expense. OASCI, medical, income tax, health insurance, these are all part of salaries and wages expense. So those would also be included in that, and that's why we put the full 10,000 in our salaries and wages. Does anybody have any questions about this one? Okay. So the payroll register is used to record the payroll journal entry. And so here we have a payroll journal entry. There's a lot of lines on here. So first what we're going to do is we're going to debit our salaries and wages expense. And as we noted on the prior slide, that's going to include everything. So we have one line for that, and that total debit is the full amount for $28,580. And just to show you where we got this number, I'm going to go back to that other slide real quick. If you look down here in the bottom, we have the $28,580. This is our total salaries and wages expense for the current period. So we see it's also right here. Okay, and these numbers should tie. Current period earnings, salaries and wages expense. They should equal the same. This is the number that we are going to put in our journal entry. So over here in our journal entry, we've debited that $28,580, but now we need to credit as well to make sure that our debits and credits equal. So we're just going to bring in the totals for each of these accounts for that particular period. So I'm not going to go through all of these, but for example, we'll look at United Way and salaries and wages payable. So $60 and $20,326. So when we go back, we see our $60 right here under other. That's the total for other. And then our net pay, $20,326. That is our total net pay. So notice we are not listing out each individual employee on this journal entry. We are just listing the total amount that is going into this account. If we listed out every single employee on here, this journal entry would be like, that's just like 5 employees, I believe. I think it was 5 employees, but this journal entry would be like 5 pages long. So we're not doing that. We're just listing out the total amounts per that period. And our note is to record salaries and wages expense and payroll withholdings. So employers must pay at least three payroll taxes. 2 of those are unemployment compensation taxes. These taxes are not withheld from employees' gross earnings, but instead they are paid by the employer. Employer FICA and OASDI and Medicare, state unemployment compensation tax, also known as SUTA, and federal unemployment compensation compensation tax, also known as FUTA. So when you do look at your paycheck, you might see, you're probably not going to see all this. It's more than likely going to show these abbreviations. So I know, some people are like, what is SUTA, SUTA, or FUTA? So that's what those are. And that's just where the employer is paying these different unemployment compensation taxes on your behalf. So here we have, this is on page 566. So here we have employer payroll taxes. And we're looking, we've got our net take-home pay, which is $723, the lower number. All right, so our net take-home pay was $723. And now we've also got our OASDI. And in this example, they're telling us that is 6.2%. On the first 117,000. So until you get to that number, your tax amount will be 6.2%. So we're going to find the 6.2% of the take home is $62. We've got our Medicare at 1.45%. We've got our income tax at 20%. So this is our employees' taxes and other withholdings. And so this is on the employees side. So the employees side is $1,000. And then the employer, we're adding together all of these amounts for the employer. The employer side is $137. And so the total amount that's going to be paid is $1,137. And then, so now we have Smart Touch Learning. They record the employer's payroll tax expense as a debit to payroll tax expense and a credit to the various payable accounts. So we're going in and we are recording that we have our payroll tax expense. So we're going to debit payroll tax expense by the $2,073, and we're going to credit all of these payable accounts by the amount that we've calculated, and the note is to record our employer's payroll tax expense. Internal controls. Internal controls are a big deal because this is how we can hopefully deter people from potentially committing fraud. And sometimes it could be accidental. But a lot of times it's where, and if it's with an employee, a lot of times it's where an employee is doing something and they're noticing a gap in the system somewhere, I don't know, and they realize that they might be able to, we'll just stick with like money or something. Let's say like money and accounts. Maybe they're the only one that oversees this money, and they realize they could probably take a little bit of the money at a time and no one would know, or no one would notice because no one's coming back and checking. And even though they know it's wrong, maybe they all of a sudden they're in a tough spot and they're like, you know what, I could probably do this. Maybe I'll just do it for a little while just to help me catch up. And then what happens? They start doing it and they're not getting caught. And so then they keep doing it, and eventually, more than likely, they will get caught. But now they've done, like they've just really, there are so many different ones out there that you can read about and study. And it's like if you, what was the movie? I can't remember the name of the movie. There was one movie that I watched and I was like, if you would have just stopped after like, I don't know how long they did it, but let's just say they did it for like a year and then they got caught. If you would have just stopped after 6 months, you probably never would have got caught, but you got greedy and you kept doing it. And they started looking into it And next thing you know, so there are a lot of different ways that people can and even like with inventory. So it doesn't even have to be money. It could be inventory. Let's say there's this room is full of stuff, and maybe the company doesn't have an inventory system that accounts for all of that. And you know this, and you're like, well, I just need an extra pen. And then all of a sudden you're like, okay, I need some notebooks. Oh, well, now my kid needs school supplies. I'll just go get them out of the inventory room. And next thing you know, it's always like, it seems like when you hear about these, it's like they started small and then they just kept growing. And then eventually though, someone more than likely will notice, they're like, wait a minute, we're buying notebooks a lot more often and we don't have any extra need for those. So something's going on. Then they start looking and they put up that hidden camera or something. Next thing you know, you're busted.
It's funny you said that. Our top like ETLs at Target just got fired for like stealing Stanley cups out of inventory. It was like the Valentine's Day ones.
It's crazy.
They have a lot of them too. Yeah.
And a lot of times it's stuff that's probably not worth it because it'll completely ruin I mean, it goes on your record. Nobody wants to hire people that are, that do that. So you just got to be careful. So that's why we have internal controls. And internal controls also help to deter that behavior. Because if you know someone's coming behind you and checking the inventory and they're seeing how many notebooks we have in this room, then you're less likely to be tempted to take one because you know somebody's going to come in there and they're going to count it and then they're going to start looking to figure out where it went. So internal controls are very important. They help to deter it, which can really, honestly, could have saved the Stanley Cup people. Not saying that they don't have good internal controls at all, because sometimes, people just, but they got caught. So apparently they do have some good.
For inventory, so I guess they thought they could mark it off and you don't even notice.
They're in the inventory department.
Yeah.
So that's why we have these internal controls, and we have to make sure that we have someone else that's also checking this stuff behind us. And then also it could just be like human error. So same example, but let's say they didn't do it on purpose. Maybe they missed a box. Maybe they just, I'm not like defending them because I don't know. But let's say instead of them physically taking the cups out of there, let's say they missed a box, the box is sitting in the back, and people just kept sticking other inventory stuff on top of it. And then we noticed in our internal controls, we're checking everything and we're like, we're missing a whole box of cups. Like, somebody just walk off with them? Yes, sir.
Money, like, especially with grocery stores, there's a lot of stolen items. So I'm thinking somebody who's in charge of inventory could steal and mark it off as stolen.
Could be. Or, now we're getting into a whole, some people may, you could even mark it as spoiled when really it's not. And we threw it in the trash. We threw it away. Now, most companies these days have controls where if you say we received it and it was already spoiled, we are still going to check. We're going to send it back. But some companies just throw it away.
Yeah,
And
especially companies, they throw everything away.
And so with that's where someone could say, and don't do this because you could get caught and they have cameras everywhere. But yeah, someone could say, oh, we got a whole case of milk and it was all rotten. Like one of the milks was busted and it smelled really horrible. So we just put it in the dumpster and really they stuck it in their trunk. You never know. So we have these internal controls in place. The proper way to go about that would be, okay, if all inventory that we receive, no matter what, we have this person check the inventory in. And as they're checking the inventory in, if they notice that there's a case of milk that's spoiled, we sit that on this side and everything else is good. We put over here, but we're still checking it all in to make sure we received it. And then we have another person that comes in, takes their report from them, checks to make sure that this milk and stuff is really spoiled. They confirm that it is or is not, and then they continue on with the process. But then some businesses are small. Publix is big, but some businesses are small and they can't afford to pay people to do that. They can't afford to pay 2 people to do the same job in a sense. And it's those small businesses that are the ones that really, I feel like they really are the ones that are in danger of being, stolen from by their employees because they just don't have the manpower to check all that stuff. So if you do, though, you definitely want to make sure that you have some double checks. So we have 2 different controls that you can use for payroll, because payroll is one where this happens frequently as well. So for efficiency, so we want, payroll is usually automated. Normally it's always through a system, some type of system. And these days people use ADP, QuickBooks, Paycom, different types of payroll systems. Controls to safeguard payroll, having employees sign for their checks or present an ID. And this is for larger companies. If it's a small company and you know your employee face to face, you've got like 5 employees and you see them every day, then obviously you're probably not going to have them sign for their check. Well, you might have them sign for it, but they're not going to have to show you an ID because you know that Joe is Joe and John is John. But if it's a large company and you don't see these employees every day, you may want them to present their IDs just to ensure that you're really giving the proper employee their check. Hiring and firing is separated from payroll prep. So the people that prepare the payroll are not doing the hiring and firing. Why do you think that is? If they're hiring, they could hire some bogus person, right? And put them on the payroll. And then down the road, we're like, man, who is this? I'll just use the same name, John. Who is John? I've never met John before. Did he come to our company parties or anything? And then you find out later on it was Sarah. And she's been writing checks to her bank account for John that doesn't exist. There are a lot of other, Social Security cards, things like that. There are other checks as well, but people find ways around this stuff. We hear about it all the time. People are still finding ways around this. So it's really important to have these internal controls. Time clocks and direct deposit are also used. So I remember one of my first jobs, we had I can't remember what it was called, but it was like it was like a machine, and you had a punch card. It was a punch card. And so you had this little card with your name on it, and then you would go and you would put the card in, and you would let it stamp the day and time that you arrived. And then when you left for lunch, you would stamp it, come back, stamp it, leave, stamp it. And that was just so that the company could track when you were there and when you weren't there. We did find out that 2 people were punching each other's cards for them. So, like, one of them would get there on time, I guess, and they would clock themselves and the other employee in. And it happened a couple of different times before we caught it. And it was like, and here's the thing, we caught it because we're like, okay, so-and-so's saying that they're here at 8 o'clock every day, but we never see them. Like, what do? Go hide out in the bathroom or something? Because they're punching in at 8, but they're not here. So then we started watching to see, and then both employees got in trouble. But and you may think it's not a huge deal because you're like, well, I was just trying to make sure that I knew that so-and-so was going to be, and it could be like 5 minutes, and they're just like, I knew so-and-so was going to be 5 minutes late. It was just 5 minutes. But it's not just 5 minutes, especially not when you do it multiple times. And it sounds terrible, but on the company's perspective, that's 5 minutes of stolen time every time you do that, which is money that you're stealing from the company. And people don't see it that way. They're like, no, I was just clocking in, instead of, just clocking them in. But you're also stealing money from the company because you're not here, but you're still going to get paid for it on your check. So it's stealing. Yes, ma'am.
I used to work at Walmart, and our time clock system, like, you can clock in and leave. Like, people would leave.
Mm-hmm.
And like the next day it would be like, oh, you missed your clock out time, and they would just adjust it to the time they were supposed to be. So people would just get
Yeah.
like away, like real fast with stuff like that.
Yeah, it's crazy. And I'm like, and seeing stuff like that with like Walmart, there are so many employees that, you know, and I think a lot of times they're not necessarily designated, unless they're a cashier, I think. But like if you're on the floor and you're just kind of like making sure that the store is neat and making sure everything's stocked and the clothes are,
Warehouse though.
yeah,
Yeah.
People do that. We
it's crazy.
They be clocking in, go in their car, and come back and come down.
It's not good. So look, there's probably a camera somewhere. You better be careful, okay? And some cameras are very well hidden. I mean, y'all heard of like nanny cams and stuff. I mean, they had cameras and everything. So don't do it. Don't do it. But yeah, it's crazy. It's crazy the things that people come up with, and then you don't even realize. You look at it as, you may not even look at it as stealing money from the company, but that's how it is. That's technically what it is. So you want to be very careful because you don't want that you don't want that kind of stuff to follow you around. Does anyone have any questions about that? No? Okay. Do you guys need, actually I think do you guys need a little 5-minute break, or do you want to just push through this chapter?
Just push through.
Push through? Okay, we'll push through. I think we only have a couple more slides left. All right, so account for current liabilities that must be estimated. So a business may know that a liability exists, but they don't know the exact amount of the liability. We know that we're going to have this liability coming up that we're going to have to pay, but we have no clue how much it is. So we have to estimate what we think the amount is going to be, and we have to put that on our balance sheet. And we probably do this maybe in our personal lives. So it's the first of the month, and we know that we're going to get our cell phone bill or our internet bill, you know, some type of bill that changes monthly. We know we're going to get that on the 15th, and we're going to have to pay it. And maybe we only get paid once a month on the 1st. And so we're like, okay, I know I'm going to have to pay this bill, this liability. I don't know how much it's going to be. So I'm going to estimate it so that I can make sure I keep that in my bank account so that when I do get the bill, I can pay it, hopefully. Hopefully I don't underestimate it. So companies do the same thing. They estimate liabilities, and they still have to report those on their balance sheet to show that they have this liability. Some common examples are bonus plans, vacation pay, health and pension, expense benefits, and warranties. So this is on page 568. We're going to assume that Smart Touch Learning estimates that it will pay a 5% bonus on annual net income after they deduct the bonus. The company reports net income of $315,000 before the calculation of the bonus. So if you look in your book on page 568, we will see here they show us how they calculate the bonus. So they took the bonus percent times net income before the bonus. They divided that by 1 plus the bonus percent. So to plug those numbers in, we were told the bonus was 5%. So in your book, you'll see 0.05 times the total, 315,000. And then we divide that amount by 1 plus the percent, which is 1 plus 0.5, so 1.05. And when we do that, we're going to be left with 15,000. So that is how we calculated the bonus. You may have to calculate this, so just make sure that you refer back to this page 568. This formula allows you to back into the bonus amount. So for example, net income minus the bonus is 300,000, which is the 315,000 minus the 15,000. The bonus of 15,000 is really 5% of the net income after the bonus has been subtracted. So you could take the bonus out first, and that would be 300,000 times 5%, which equals your 15,000. So just refer back to this page if you need to. So vacation, health, and pension benefits. Businesses typically offer vacation, health, and pension benefits to employees. A pension plan provides benefits to retired employees. SmartTouch Learning estimates the cost of providing vacation benefits is $1,000 per month. So we're estimating that the cost of vacation benefits is $1,000 per month. So we're going to debit our vacation benefits expense by $1,000, and we're going to credit vacation benefits payable by $1,000. And this is to record employee vacation benefits expense. And then warranties. Many corporations guarantee their products against defects under warranty agreements. The time period of warranties varies by product and company. The matching principle requires businesses to record warranty expense in the same period that the company records the revenue related to the warranty. The matching principle requires businesses to record warranty expense in the same period that the company records the revenue related to the warranty. Same period. So here we're going to assume that SmartTouch Learning made sales on account of $50,000. This is page 569. $50,000 is the cost of merchandise inventory sold, which was, let me start that over. So SmartTouch Learning made sales on account of $50,000. The cost of merchandise inventory sold was $35,000, which is subject to product warranties on June 10th, and estimate warranty cost will be 3% of sales. The company would record the sales revenue, cost of goods sold, and estimated warranty expense as follows. And we see this on page 569. So we're going to debit accounts receivable for $50,000, credit sales revenue for $50,000. This is for a sale on account. Debit cost of goods sold for $35,000, credit merchandise inventory for $35,000 to record the cost of goods sold. Debit warranty expense $1,500, credit estimated warranty payable for $1,500. Now here we see they're showing us how we calculated our warranty expense. So note that as well. This is another formula. To calculate the warranty expense, they took the $50,000, which was the amount of the sale. They multiplied it by 3%, which is what we estimated our warranty cost to be. So the sell amount times the cost percentage, times the warranty percentage tells us what our warranty expense is. And that's in the book on 569 as well. So we're going to assume that some of SmartTouch Learning's customers make claims that must be honored through the warranty offered by the company. The warranty costs total $800 and are made on June 27th. So on June 27th, we're debiting our estimated warranty payable of $800, and we're crediting our merchandise inventory. And this is to replace merchandise inventory under warranty. Does anyone have any questions about that right now? Not yet. All right, accounting for contingent liabilities. So a contingent liability is a potential liability that depends on a future event. It's something that we think might possibly happen. It's contingent. A contingent liability, for a contingent liability to be paid, an event must happen in the future. How businesses record contingent liabilities is based on the likelihood of the event occurring in the future. And so we have three different likelihoods that we use for this. Remote, reasonably possible, and probable. A remote likelihood we do not disclose. We think it more than likely probably is not going to happen, or it's very unlikely, but we still, because it's likely, we're still going to, we consider it, but we're not going to disclose it. Reasonably possible, we are going to report. We're going to describe the situation in a note to our financial statements. So at the end of the year, some companies every month, some companies every quarter, some companies annually send out their financial statements. And if it's reasonably possible that this event might occur, we're going to put a note in the financial statements describing this event that may possibly happen. If it's probable, meaning that it's more than likely probably going to happen, it's probably going to happen, it's probable. We're going to describe it in a note to the financial statements. And this is if it's probable and we can't estimate the amount. So if it's reasonably possible, or if it's probable but we cannot estimate the amount, therefore we have no number, then we're going to describe it in a note on our financial statements. This might occur. If it's probable and the amount can be estimated, more than likely it's going to happen, and we have an idea of how much it's going to cost. Not exact. The amount's definitely probably not going to be 100% correct, right? We're going to be off somewhere. But we can estimate what it's going to cost. It's probable and we can estimate it. We're going to record this as an expense and a liability based on what we estimate it to be. So if we estimate it to be $50,000, we're going to put it on our books. We're going to put an expense and a liability down for $50,000 based on this contingent liability that's probable and can be estimated. Any questions? Okay. So using the times interest earned ratio to evaluate business performance. So how do we use the times interest earned ratio to evaluate business performance? Investors can use the times interest earned ratio to evaluate a business's ability to pay interest expense. A high interest coverage ratio indicates a business's ease in paying interest expense. And the formula for this, we take times interest earned ratio equals net income plus our income tax expense plus our interest expense, and we divide all of that by the interest expense, and that's going to give us our times interest earned ratio. Do y'all have any questions about that? No? Okay. That is this chapter. If you guys, want to take like a 5-minute break and then come back and then we'll continue.